Ever lost $20 on a bad bet? Now imagine losing $20 billion. The history of finance isn't about numbers. It's about human delusion operating at industrial scale. You navigate a world where brilliance and madness trade places daily, where yesterday's can't-miss opportunity becomes tomorrow's cautionary tale. Smart money follows the same irrational impulses as everyone else, just with more dramatic consequences when reality strikes back. Like when Meta lost $230 billion in a single day, or when entire nations went broke chasing railway dreams. In this video, we'll decode the spectacular financial catastrophes that bankrupted geniuses, toppled empires, and erased generational wealth, exposing the psychological traps lurking in your own portfolio decisions. 1. The Mississippi River Bridge collapse in 2007 exposed America's crumbling infrastructure crisis in 30 horrific seconds. During rush hour on August 1st, the 8-lane I-35W bridge in Minneapolis suddenly buckled and crashed into the river below, killing 13 people and injuring 145 others. Federal investigators discovered that a critical design flaw, gusset plates only half as thick as required, had gone unnoticed for 40 years. This catastrophic oversight occurred because the original 1960s engineering calculations had been performed incorrectly, and no subsequent inspection caught the error. In response, Congress allocated $250 million for emergency bridge repairs nationwide and mandated more rigorous inspection standards. The disaster forced Americans to confront an uncomfortable truth. Thousands of bridges across the country had been rated structurally deficient for years, yet remained in daily use. This case established the pattern we see repeatedly. Infrastructure maintenance gets ignored until spectacular failure makes the cost of neglect impossible to deny. 2. The South Sea Bubble of 1720 wasn't just any investment disaster. It was royal-approved financial madness. When the South Sea Company convinced the British government to let it take over $32 million in national debt, roughly $5 billion today, investors went wild. Even scientific genius Sir Isaac Newton got swept up in the frenzy, only to lose $20,000, equivalent to $3 million today. The company claimed exclusive trading rights in South America, but conducted almost no actual trade. When the bubble burst, it wasn't just commoners who suffered. King George I himself had become company governor 2 years earlier, lending royal credibility to what amounted to an elaborate Ponzi scheme. Parliament responded with the Bubble Act, the first major securities regulation in history, demonstrating how catastrophic failure often births crucial reforms. The man who could calculate the universal law of gravitation couldn't calculate when stock prices would fall to earth. 3. In 1716, Scottish economist John Law convinced war-bankrupted France that he could solve their financial crisis by creating paper money. His radical idea: establish a national bank issuing notes backed by land and precious metals. The scheme expanded when Law took control of French trade in the Mississippi River Valley, creating the Compagnie des Indes. Law's company issued vastly more paper currency than it had gold reserves, while stock prices soared to absurd heights. The bubble created so much artificial wealth, it birthed a new word: millionaire. But when skeptical investors began demanding gold instead of paper, the house of cards collapsed. The Mississippi bubble disaster devastated France's economy for years and made Europeans deeply suspicious of paper currency. Law, once celebrated as a financial genius, fled France disguised as a woman. His spectacular failure delayed France's adoption of modern banking systems by decades. 4. Railway mania swept through 1840s Britain like a fever, turning sensible businessmen into gambling addicts. The success of early rail lines convinced investors that any railroad would yield massive profits. Parliament approved hundreds of new railway companies, many proposing lines to the same destinations. Speculators bought shares with borrowed money, driving prices to unsustainable heights. By 1846, British railways had attracted more capital than all other British industrial enterprises combined. When the bubble burst, countless investors faced ruin. The government discovered many proposed railways had never intended to build actual lines. They existed solely to sell shares to gullible buyers. Though the crash devastated many families, It left Britain with the world's most extensive railway network, proving that sometimes investment manias create lasting infrastructure, even as they destroy individual fortunes. The rails remained long after the empty stock certificates were used as wallpaper. 5. Charles Ponzi didn't invent the scheme that bears his name, but he perfected it with such flamboyant style that history awarded him the dubious honor. In 1919, this charming Italian immigrant noticed a loophole in international postal reply coupons that theoretically allowed for arbitrage profits. Promising investors 50% returns in just 45 days, Ponzi collected millions from eager Bostonians. By summer 1920, he was taking in nearly $1 million daily. His secret? He simply paid early investors with money from new investors. No actual business existed. When journalists exposed his fraud, angry mobs surrounded his office. The scheme collapsed, costing victims $20 million, over $250 million in today's money. Ponzi served prison time but remained unrepentant, later writing, "Even if they never got anything for it, it was cheap at that price." His case forced regulators to create stricter securities laws that still protect investors today. 6. Swedish businessman Ivar Kreuger built a global match empire in the 1920s, controlling 75% of worldwide production. Known as the Match King, Kreuger leveraged his monopoly to make loans to cash-strapped Europeans, governments, in exchange for exclusive match-selling rights. Wall Street considered him a financial genius until the Depression hit. When Kreuger needed more investor cash to maintain his scheme, he created elaborate fake documents showing huge profits. By 1932, his fraud became unsustainable. Kreuger shot himself in his Paris apartment rather than face exposure. Investigators discovered he had fabricated $250 million in assets, about $5 billion today, and issued fake securities. The scandal shocked international markets and prompted the U.S. Congress to pass the Securities Act of 1933, establishing the modern framework of securities regulation. Kreuger's fall showed that even genius businessmen sometimes build empires on nothing but smoke and mirrors. 7. The 1929 stock market crash still stands as the financial catastrophe against which all others are measured. During the Roaring '20s, ordinary Americans piled into stocks, often borrowing heavily to buy more shares. Market values became completely disconnected from business fundamentals. When the inevitable correction came in October 1929, panic selling created a downward spiral. A $100 investment at the market peak would have shriveled to just $21 by May 1932, a staggering 79% loss. The crash wiped out billions in wealth and triggered the Great Depression. Many investors who bought stocks with borrowed money, on margin, were completely wiped out. The catastrophe led to fundamental reforms, including the creation of the Securities and Exchange Commission and regulations separating commercial and investment banking. These safeguards, though later weakened, helped prevent similar disasters for decades. 8. In 1869, charismatic actress Adele Spitzeder opened a private bank in Munich, promising extraordinary monthly interest rates of 10%, far above what legitimate banks offered. Despite having no banking experience, Spitzeder attracted thousands of depositors, mainly working-class people and servants who trusted her folksy demeanor. She kept careful records of deposits but did no actual banking or investing. Instead, she used new deposits to pay interest to earlier customers, the classic Ponzi structure. For 3 years, her scheme flourished, with crowds literally camping outside her office to deposit funds. When a newspaper investigation finally triggered a bank run, authorities discovered she had defrauded 32,000 people of today's equivalent of $38 million. Spitzeder's 7-year prison sentence did little to comfort ruined families who had entrusted her with their life savings. Her case became a cautionary tale throughout Bavaria about the dangers of investments promising implausibly high returns. 9. The Florida real estate bubble of the 1920s transformed swampland into gold through the magic of speculation. As automobile ownership expanded and Americans grew wealthier during the Roaring '20s, Florida's warm climate attracted northern investors looking for vacation properties and quick profits. Developers carved thousands of lots from previously worthless swampland, selling them sight unseen to buyers who had no intention of building homes. They simply wanted to flip the properties to the next sucker at higher prices. Land that sold for $8,000 one week might change hands for $20,000 the next. The frenzy peaked in 1925 when two devastating hurricanes hit the state, exposing shoddy construction and infrastructure. The bubble's collapse bankrupted developers, banks, and speculators, foreshadowing the nationwide crash that would follow 4 years later. Many Floridians today still live in communities originally platted during this manic period. 10. The Panic of 1873 began when America's leading investment bank, J. Cook and Company, closed its doors after overextending itself financing the Northern Pacific Railway. When news reached Wall Street on September 18th, the stock exchange shut down for 10 days, the first time in its history. The panic spread nationwide, triggering bank failures and industrial bankruptcies. Railroad construction, the era's tech sector, ground to a halt, throwing thousands out of work. The resulting depression lasted 5 years, with unemployment reaching 14%. The crisis exposed how deeply America's financial system depended on a few overextended private banks with inadequate reserves. Public outrage fueled populist movements demanding banking reform, though meaningful change wouldn't come until the Federal Reserve's creation 4 decades later. This case demonstrated how infrastructure investment booms, when financed with excessive leverage, can trigger system-wide collapse. 11. The Panic of 1907 erupted when copper magnate F. Augustus Heinze and his associates attempted to corner the market in United Copper stock, driving up prices by buying shares while secretly controlling most available supply. When their scheme collapsed, depositors rushed to withdraw funds from banks associated with these financiers. The panic spread to trust companies, less regulated institutions that had invested heavily in stocks. With no central bank to provide emergency liquidity, the financial system teetered on collapse. J.P. Morgan personally organized a consortium of wealthy financiers to prop up failing institutions, deciding which would be saved and which sacrificed. The crisis, which saw stock prices fall by nearly 50%, revealed dangerous structural weaknesses in America's banking system. Public outrage at having the nation's economic fate determined by private bankers led directly to the Federal Reserve's creation in 1913. 12. Boston in 1878 witnessed one of history's first female-led investment frauds when Sarah Howe opened the Ladies' Deposit Company, a bank exclusively for unmarried women. Promising an impossible 8% monthly interest rate, Howe targeted working women with limited financial knowledge. Her genius lay in creating an aura of exclusivity. Women needed recommendations from existing depositors to join. This created a cult-like atmosphere where doubters were shunned by true believers. For 2 years, Howe paid dividends using new deposits until a newspaper investigation exposed her scheme. When arrested, she had stolen over $500,000, equivalent to $13 million today, from roughly 1,200 women. Howe served 3 years in prison but later opened another fraudulent bank. Her case highlighted how investment scammers exploit social connections and target vulnerable populations who face discrimination from mainstream financial institutions. 13. The equity funding scandal of the early 1970s pioneered a bizarre new form of financial fraud: fake life insurance. Between 1964 and 1973, the California-based insurance and mutual fund company claimed to have sold thousands of life insurance policies. In reality, employees created fictional policyholders, complete with fake medical exams and documentation. The company then sold these non-existent policies to reinsurance companies for immediate cash. At its peak in 1972, roughly 56,000 of the company's 97,000 life insurance policies existed only on paper. When whistleblowers finally exposed the scheme, investigators discovered the company had fabricated over $500 million in assets. The revelation devastated institutional investors and policyholders alike. The scandal prompted massive regulatory reforms in insurance oversight and auditing procedures. It also demonstrated how corporate culture could become so corrupt that hundreds of employees participated in fraud without blowing the whistle. 14. The European Kings Club collapse in 1994 demonstrated how pyramid schemes could transcend borders in an increasingly globalized economy. Led by Damara Bergis and Hans-Günther Spachtholz, the organization sold investment letters valued at 1,400 Swiss francs, promising to double investors' money within a year. Operating across multiple European countries, the EKC used quasi-religious language and cult-like gatherings to build member loyalty. The scheme grew so large that in some Swiss cantons, approximately 1 adult in 10 had invested. When authorities finally shut down the operation, losses totaled about 1.1 billion. The investigation revealed no legitimate business activity, just the classic pyramid structure where early investors were paid with new members' contributions. The case highlighted how difficult it was for regulators to coordinate across jurisdictions, allowing sophisticated scammers to exploit gaps between national enforcement regimes. 15. Mark Twain, America's greatest humorist, made one decidedly unfunny investment that bankrupted him. In the 1880s, Twain became obsessed with the Page Compositor, a mechanical typesetting machine with an astounding 18,000 parts. Convinced it would revolutionize printing, Twain invested his literary earnings and his wife's inheritance, roughly $300,000, over $10 million today. The machine indeed worked, but it was too complex, too expensive, and too unreliable. Meanwhile, a competing typesetter, the linotype, proved far more practical and dominated the market. By 1894, Twain was bankrupt, forced to embark on a worldwide speaking tour to repay his debts. This devastating loss taught Twain a bitter lesson about technological investment. The best technology doesn't always win the market. Reliability and simplicity often matter more than theoretical superiority. Despite his financial acumen in other areas, Twain later admitted, "I was born with a mind for losing money." 16. The Rich Man's Panic of 1903 demonstrated how political intervention could spook even the wealthiest investors. When President Theodore Roosevelt began aggressively enforcing antitrust laws against railroad monopolies, Wall Street titans panicked. Unlike previous financial crises that affected the general public, this panic primarily hit the portfolios of America's financial elite. The Dow Jones Industrial Average fell 15% in a single day as major industrialists feared their monopolistic empires would be next on Roosevelt's target list. J.P. Morgan personally appealed to Roosevelt to back off, but the president refused to compromise his trust-busting agenda. The panic eventually subsided, but it established an important precedent. Government regulation could significantly impact markets, regardless of underlying economic conditions. Roosevelt's willingness to challenge powerful financial interests fundamentally shifted the relationship between Wall Street and Washington, establishing the federal government as a counterweight to unfettered capitalism. 17. Johann Baptist Placht transformed Vienna's financial scene in 1872 with a seductive pitch. Give him your money, and he'd deliver extraordinary stock market returns. As Austria's economy boomed during the Gründerzeit period, hundreds of middle-class Viennese entrusted their savings to Placht, believing his claims of investment genius. For months, he paid impressive dividends, creating a snowball effect as word spread of his market-beating performance. The secret to his success? There was no stock market investing at all, just the classic pyramid scheme of paying early investors with new investors' money. When authorities investigated, they discovered Placht had conducted 0 legitimate investments. The scheme's collapse in 1873 contributed to the wider panic of 1873 that devastated European markets. The case highlighted how even sophisticated urban populations could fall victim to investment fraud during periods of economic optimism, when skepticism gives way to fear of missing out. 18. Enron's 2001 implosion wasn't just a corporate bankruptcy, it was the spectacular unraveling of America's most celebrated company. For years, Enron used mark-to-market accounting and special-purpose entities to hide billions in debt and inflate profits. Wall Street analysts cheered as the energy trader's stock hit 90.75 in 2000. The house of cards collapsed when investigators discovered CFO Andrew Fastow had created hundreds of shell companies specifically designed to hide losses and enrich executives. Enron's stock plunged to 26 cents, wiping out $74 billion in shareholder value. The catastrophe destroyed not just a company but also Arthur Andersen, one of the world's big five accounting firms. Most tragically, 25,000 employees lost their jobs and retirement savings, which had been heavily invested in now worthless company stock. The scandal directly led to the Sarbanes-Oxley Act, fundamentally changing corporate governance and accounting standards throughout America. This hybrid of comedy and commentary might leave us asking, what's more absurd? That executives thought they'd get away with it, or that for years they actually did? 19. WorldCom pulled off the largest accounting fraud in American history by treating basic operating costs as capital investments. Under CEO Bernie Ebbers' leadership, the telecommunications giant reported billions in profits while actually losing money. The scheme was shockingly simple. When WorldCom couldn't meet earnings targets, accounting staff simply moved operating expenses to the capital expenditure column, an accounting trick that let them spread costs over years instead of reporting them immediately. By the time the fraud was discovered in 2002, the company had falsified $11 billion in earnings. WorldCom filed for bankruptcy with $105 billion in assets, at that time, the largest bankruptcy in U.S. history. Ebbers received a 25-year prison sentence, though thousands of employees who lost jobs and retirement savings found little comfort in his punishment. The WorldCom debacle, following so closely after Enron, destroyed public trust in corporate America and led to more stringent accounting oversight, proving that sometimes the biggest frauds hide in plain sight. 20. Bernard Madoff's Ponzi scheme began innocently in the 1960s when he lost money on a bad investment for his father-in-law's friends and, rather than admit failure, created fake trades to cover it up. This deception spiraled into the largest financial fraud in history, with Madoff claiming to generate consistent 10–15% annual returns regardless of market conditions. His exclusive investment club attracted billions from wealthy individuals, Jewish charities, and even sophisticated financial institutions. For decades, Madoff maintained the illusion by refusing some potential investors, creating an aura of exclusivity that made others desperate to participate. When markets crashed in 2008, clients requested $7 billion in withdrawals, exposing the fraud. Investigators discovered Madoff had never made a single legitimate investment with client funds. His 150-year prison sentence offered cold comfort to victims who lost $65 billion on paper, including many elderly investors left destitute. The scandal forced regulators to completely rethink their approach to monitoring investment advisors. 21. Lehman Brothers' 2008 collapse marked the largest bankruptcy in history and catalyzed the global financial crisis. Founded in 1850, the venerable investment bank had survived the Civil War, 2 World Wars, and the Great Depression, only to be undone by subprime mortgages. Under CEO Richard Fould's aggressive leadership, Lehman accumulated massive positions in commercial real estate and mortgage-backed securities, often using accounting tricks to hide the true extent of its leverage. When housing prices declined, these assets plummeted in value, leaving Lehman desperately seeking buyers. After the government rejected bailout requests and potential acquirers walked away, Lehman filed for bankruptcy on September 15, 2008. The filing triggered a chain reaction. Global markets plunged, credit markets froze, and the entire financial system teetered on collapse. The shocking fall of a 158-year-old institution proved that no bank was too big to fail, and fundamentally changed regulatory approaches to financial institution oversight. 22. Washington. Mutual's spectacular failure in 2008 represented the largest bank collapse in American history. In the early 2000s, WaMu aggressively expanded into subprime lending, with adjustable-rate mortgages offered to borrowers with questionable credit. CEO Kerry Killinger's strategy generated impressive short-term profits, but built a time bomb on WaMu's balance sheet. When housing prices declined, foreclosure rates skyrocketed. In September 2008, after Lehman Brothers' bankruptcy sparked widespread panic, WaMu depositors withdrew $16.7 billion in just 10 days, the largest bank run in U.S. history. Federal regulators seized WaMu and sold its assets to JP Morgan Chase for $1.9 billion, a fraction of its former value. The collapse vaporized shareholder equity, including the retirement savings of many long-term employees. Once America's sixth-largest bank with over $300 billion in assets, WAMU's downfall demonstrated how rapidly depositor confidence can evaporate when financial institutions prioritize growth over risk management. 23. Pets.com embodied the irrational exuberance of the dot-com era with its iconic sock puppet mascot and Super Bowl commercials. Despite having Amazon as an investor and spending $17 million on advertising in early 2000 alone, the online pet supply retailer had a fatal flaw in its business model. Shipping heavy bags of dog food and kitty litter was wildly unprofitable. The company lost money on nearly every sale. After raising $82.5 million in its February 2000 IPO, Pets.com's stock price peaked at $14 before collapsing to 22 cents just 9 months later. By November 2000, the company had shuttered, having burned through its capital at a blistering pace. The Pets.com debacle became a cautionary tale about valuing marketing over fundamentals and rushing to public markets before proving business viability. The sock puppet outlived the company, eventually being sold to a loan company in bankruptcy proceedings. 24. Long-term capital management's 1998 collapse nearly triggered a global financial meltdown despite being run by financial geniuses, including 2 Nobel Prize-winning economists. LTCM used sophisticated mathematical models to identify market inefficiencies, leveraging these tiny advantages by borrowing massively. At its peak, the hedge fund had $4.8 billion in equity, supporting over $100 billion in assets, with derivatives exposure exceeding $1 trillion. When Russia unexpectedly defaulted on its debt in August 1998, markets moved in ways LTCM's models deemed mathematically impossible. Within weeks, the fund lost over $4 billion. Fearing that LTCM's failure would cascade through global markets, the Federal Reserve orchestrated a $3.6 billion bailout by major banks. The crisis revealed how excessive leverage could transform minor market movements into systemic threats, and demonstrated that even brilliant mathematicians could fatally underestimate the role of panic and human psychology in financial markets. 25. The dot-com bubble burst of 2000 wiped out $5 trillion in market value as investors finally acknowledged that eyeballs and mindshare weren't substitutes for actual revenue. During the late 1990s, any company with .com in its name could raise millions, regardless of business fundamentals. Venture capitalists funded startups with no clear path to profitability, rushing them to IPO, where retail investors bid share prices to stratospheric levels. The Nasdaq Composite Index soared from 750 to over 5,000 points in 5 years, only to crash when reality set in. By October 2002, the index had lost 78% of its value. Thousands of internet companies vanished, with many burning millions in investor capital each month on Super Bowl ads, lavish offices, and exorbitant executive salaries. The crash taught investors painful lessons about valuation metrics and business fundamentals that many seem to periodically forget, as each new technology wave brings fresh temptation to abandon time-tested investment principles. 26. AOL's purchase of Time Warner in 2000 stands as the worst merger in corporate history. A $182 billion marriage consummated at the absolute peak of dot-com hysteria. AOL used its grossly inflated stock to acquire Time Warner's content empire, promising synergies between old and new media. What followed was a textbook case of cultural incompatibility and strategic mismatch. Traditional Time Warner executives resented being acquired by what they viewed as an overvalued upstart, while AOL's business model collapsed as dial-up internet gave way to broadband. By 2002, the combined company reported a staggering $99 billion loss, at that time the largest in corporate history. The merged entity's market value plummeted from $350 billion to under $20 billion. In 2009, Time Warner finally spun off AOL at a valuation less than 1% of the original purchase price. The catastrophic failure became a business school case study in how even the most celebrated corporate combinations can destroy shareholder value when based on temporary market euphoria rather than sustainable competitive advantage. 27. Black Monday, October 19, 1987, saw the Dow Jones Industrial Average plunge nearly 23% in a single day, the largest percentage drop in Wall Street history. Unlike previous crashes triggered by economic fundamentals, this collapse was primarily driven by computerized trading programs and market psychology. As stocks declined, automated portfolio insurance systems automatically sold futures contracts, creating a feedback loop of accelerating sales. With trading systems overwhelmed, market makers withdrew, creating a liquidity vacuum that sent prices into freefall. The crash wiped out $500 billion in wealth in just hours. Regulators responded by implementing circuit breakers that temporarily halt trading during extreme volatility. Though initially feared as the beginning of another Great Depression, the crash proved relatively contained. Markets recovered much of their losses within months. Black Monday demonstrated how technological innovation could create new forms of market risk, as algorithms reacted to price movements faster than human traders could intervene. 28. Barings. Bank's 1995 collapse ended a 233-year financial dynasty that had financed the Napoleonic Wars and counted the Queen of England among its clients. The venerable institution was destroyed by a single trader, 28-year-old Nick Leeson, who ran both the trading desk and back-office operations at Barings' Singapore branch. This catastrophic lack of oversight allowed Leeson to hide massive losses from unauthorized derivatives trading in a secret account. When the Kobe earthquake sent Asian markets plummeting in January 1995, Leeson doubled down on his risky positions, hoping to recoup losses. Instead, he dug a deeper hole, eventually losing $827 million, more than twice Barings' available capital. The bank collapsed over a single weekend, shocking the financial world and demonstrating how poor risk management could allow a single rogue trader to destroy even the most established institution. Barings was sold to Dutch bank ING for the symbolic sum of $1, ending centuries of banking history. 29. The Bank of Credit and Commerce. International (BCCI) scandal revealed how a global bank could operate as essentially a criminal enterprise. Founded in 1972, BCCI grew rapidly to over 400 branches in 78 countries, presenting itself as a third-world development bank. Behind this facade lay what investigators later called the largest and most complex fraud in banking history. BCCI systematically engaged in money laundering, terrorist financing, arms trafficking, and bribery of government officials worldwide. The bank maintained parallel books to hide losses and criminal activities, creating an impenetrable web of shell companies and offshore entities. When regulators finally moved against BCCI in 1991, they coordinated a simultaneous shutdown across 73 countries. The collapse left 1.4 million depositors facing losses of over $18 billion. The scandal exposed dangerous regulatory gaps in international banking and prompted major reforms in cross-border financial oversight. It also revealed how easily sophisticated criminals could exploit the fragmented global financial regulatory system. 30. MF Global's 2011 collapse showed how quickly a financial firm can disintegrate when it violates the sacred trust of segregated client accounts. Under CEO John Corzine, the former Goldman Sachs chairman and New Jersey governor, the commodities brokerage made increasingly risky bets on European sovereign debt. When these positions soured, the firm faced a severe liquidity crisis. In desperation, MF Global executives improperly transferred $1.6 billion from segregated customer accounts to cover the firm's trading losses, a cardinal sin in financial services. The firm filed for bankruptcy on October 31, 2011, becoming the 8th largest bankruptcy in U.S. history. Farmers, ranchers, and traders who used MF Global to hedge commodity prices suddenly found their accounts frozen or missing funds entirely. Though customers eventually recovered most of their money through bankruptcy proceedings, The breach of client fund segregation shocked the financial industry and led to significant regulatory reforms in how brokerages must protect customer assets. 31. Peregrine Financial Group's 2012 collapse revealed a 20-year fraud perpetrated by its founder and CEO, Russell Wasendorf Sr. For 2 decades, Wasendorf forged bank statements to hide his theft of customer funds. Whenever regulators requested confirmation of Peregrine's bank balances, Wasendorf intercepted the letters, created counterfeit bank statements on his computer, and returned them to auditors. The scheme unraveled when the National Futures Association implemented electronic bank confirmations, bypassing Wasendorf's paper-based forgery system. Facing exposure, Wasendorf attempted suicide in his car, leaving a detailed confession that began, "I have committed fraud." Investigators discovered he had stolen $215 million from customer accounts to fund his lavish lifestyle, which included a private jet, extensive real estate holdings, and a gourmet restaurant. The case prompted regulators to implement stronger electronic verification systems for all futures commission merchants, though this came too late for Peregrine's devastated customers, many of whom lost their life savings. 32. J.P. Morgan's London whale trading debacle in 2012 demonstrated how even the most sophisticated financial institutions could fail at basic risk management. Bruno Ixel, a trader in J.P. Morgan's London office, accumulated such enormous positions in credit derivatives that he earned the nickname London Whale because his trades were moving entire markets. What began as a hedging strategy morphed into a speculative bet that ultimately cost the bank over $6 billion in losses. CEO Jamie Dimon initially dismissed concerns as a tempest in a teapot, before later acknowledging the gravity of the situation. The scandal tarnished J.P. Morgan's reputation for risk management excellence and led to over $1 billion in regulatory fines. The case highlighted how complex derivatives could mask risk rather than reduce it, and showed that even banks that had weathered the 2008 financial crisis relatively unscathed were not immune to catastrophic trading losses when internal controls failed. 33. Westridge Capital Management's collapse in 2009 demonstrated how easily sophisticated investors could be deceived by financial predators with impressive credentials. Principals Paul Greenwood and Stephen Walsh diverted investor funds to finance extravagant lifestyles, including Walsh's purchase of a $3 million home for his ex-wife, and Greenwood's collection of 348 teddy bears worth $3 million. Despite managing money for major universities and charitable foundations, the pair used investor funds as their personal piggy bank. The scheme collapsed when the financial crisis prompted investor redemption requests that couldn't be fulfilled. Investigators discovered the firm had stolen $554 million over 13 years while providing completely fictional account statements. Greenwood and Walsh both received prison sentences, but their institutional victims, including Carnegie Mellon University and the University of Pittsburgh, lost hundreds of millions of dollars, highlighting how even professionally managed endowments with fiduciary oversight could fall victim to investment fraud. 34. Warren Buffett's purchase of Dexter Shoe Company in 1993 stands as what the Oracle of Omaha himself calls his worst investment ever. Buffett paid for Dexter with 25,203 shares of Berkshire Hathaway stock, worth about $433 million at the time. He believed Dexter's strong brand and domestic manufacturing provided a sustainable competitive advantage. What he failed to anticipate was the seismic shift of shoe production to low-cost Asian manufacturers. By 2001, Dexter had closed all its U.S. factories, unable to compete with cheap imports. Meanwhile, the Berkshire shares Buffett used as currency skyrocketed in value, eventually worth over $8.7 billion today. This created a double disaster. Not only did Dexter become worthless, but Buffett gave away Berkshire shares that would have generated astronomical returns. Even genius investors make mistakes, but as Buffett ruefully noted, "I gave away 1.6% of a wonderful business to buy a worthless business." A humbling lesson from the world's most celebrated investor. 35. Bill Ackman's crusade against Herbalife cost his hedge fund over $1 billion and became one of Wall Street's most dramatic battles. In December 2012, the activist investor announced a $1 billion short position against the nutritional supplement company, calling it a pyramid scheme destined for collapse. Ackman didn't just bet against Herbalife. He launched an unprecedented public campaign, producing a 334-slide presentation and lobbying regulators to investigate the company. What Ackman didn't anticipate was billionaire Carl Icahn taking the opposite position and buying 26% of Herbalife stock. The epic billionaire battle sent Herbalife shares soaring instead of plunging. After sustaining losses for years, Ackman finally exited his position in 2018. While the FTC did fine Herbalife $200 million for misrepresentations, the company survived and thrived, and Ackman's investors suffered. The case illustrated how even the most thorough investment thesis can fail when market psychology and competing billionaires enter the equation. 36. Carl Icahn's blockbuster investment serves as a cautionary tale about the dangers of betting against technological disruption. In 1994, the legendary activist investor acquired a significant stake in the video rental giant, believing its dominant market position created substantial unrealized value. What Icahn didn't foresee was how completely streaming would obliterate the physical rental business. As Netflix and digital distribution gained momentum, Blockbuster's 9,000 stores became expensive liabilities rather than valuable assets. When Icahn finally gained board control in 2005, the company was already in terminal decline. His attempts to revitalize the business through diversification and online offerings came too late. By the time Blockbuster filed for bankruptcy in 2010, Icahn had lost over $191 million. The case demonstrated how even the most successful investors can misjudge the speed and impact of technological change. As Blockbuster's familiar blue and yellow signs disappeared from strip malls nationwide, they became symbols of a business model rendered obsolete by digital transformation. 37. Yahoo's rejection of Microsoft's $44.6 billion acquisition offer in 2008 represents one of the most expensive missed opportunities in corporate history. When Microsoft CEO Steve Ballmer offered a 62% premium over Yahoo's market price, co-founder Jerry Yang and the Yahoo board declared the bid substantially undervalued their company. They reportedly wanted at least $55 billion. Microsoft walked away, and Yahoo's stock immediately plunged 15%. What followed was a decade of declining relevance and failed turnaround attempts. By the time Verizon finally purchased Yahoo's core business in 2017, the price had fallen to just $448 billion, roughly 10% of Microsoft's original offer. The catastrophic decision destroyed tens of billions in shareholder value and cost Yang his CEO position. This hybrid of comedy and commentary reminds us that sometimes the best deal is the one right in front of you, not the hypothetical better one you imagine might come along later. Yahoo's board gambled on a future that never materialized, and shareholders paid the astronomical difference. 38. Sean Quinn's Anglo-Irish bank investment transformed Ireland's richest man into its most famous bankrupt. Starting with a $100 loan in 1973, Quinn built a business empire spanning cement, insurance, and hotels, amassing a fortune of $4 billion by 2008. Then he became obsessed with Anglo-Irish Bank, secretly acquiring 28% ownership through contracts for difference, CFDs, financial instruments that allowed him to control shares without technically owning them. When the 2008 financial crisis struck and Anglo's share price collapsed amid loan scandals, Quinn's CFD positions became a financial black hole. As Ireland entered its worst economic crisis in history, Quinn lost $3.2 billion and was forced into bankruptcy. The former billionaire was later imprisoned for contempt of court after attempting to hide assets from creditors. Quinn's spectacular fall demonstrated how even self-made business geniuses can be undone by concentrated bets outside their circle of competence, particularly when those bets are made with borrowed money. 39. Mark Faber's prediction that Obama's re-election would crash markets offers a powerful lesson in how political bias can cloud investment judgment. The Swiss investor and newsletter publisher warned subscribers in 2012 that if Obama won a second term, I am 100% sure the stock market will be lower 1 year from today. Faber claimed re-election would be a disaster for business that would trigger a 50% market crash. What actually happened? The S&P 500 rose 30% in the year, following Obama's victory, one of the strongest bull market years in history. Faber, widely respected for his earlier market calls, demonstrated how even sophisticated investors can let political opinions override objective analysis. His failed prediction highlighted the danger of making investment decisions based on partisan views rather than economic fundamentals. The case reminds investors to separate their political preferences from their portfolio strategy, as markets often move independently of which party controls the White House. 40. Meta's metaverse investment may ultimately prove successful, but its early returns have been catastrophic. In October 2021, Facebook rebranded as Meta Platforms, signaling CEO Mark Zuckerberg's all-in bet on virtual reality as the next computing platform. The company poured over $36 billion into developing metaverse technology while facing declining user growth in its core social media business. Investors grew increasingly skeptical as Reality Labs, Meta's metaverse division, lost $13.7 billion in 2022 alone, with no clear path to profitability. On February 3, 2022, Meta suffered the largest single-day market value loss in U.S. history, shedding $232 billion, a 26% plunge, after disappointing earnings. While defenders argue Zuckerberg is making a visionary long-term investment similar to Amazon's early unprofitable years, critics see a desperate attempt to create a new business model as Facebook's original platform faces increasing competition and regulatory scrutiny. Only time will tell whether Meta's massive metaverse bet represents visionary leadership or one of history's most expensive corporate miscalculations. 41. GameStop's 2021 short squeeze transformed a dying mall retailer into the epicenter of a financial revolution. When users of Reddit's Wall Street Bets forum noticed that hedge funds had taken massive short positions against GameStop, effectively betting on the company's failure, they organized a counterattack. Thousands of retail investors purchased shares, driving the price from $17 in early January to $483 by month's end, a staggering 2,700% increase. This forced short sellers to buy shares at inflated prices to cover their positions, creating a self-reinforcing cycle. The frenzy caused several hedge funds to lose billions, with Melvin Capital eventually shutting down after losing 55% of its value in a single month. While many early retail investors profited handsomely, those who bought near the peak suffered severe losses when GameStop's stock eventually crashed back to earth. The episode demonstrated the power of social media to coordinate retail investors into a market-moving force and forced regulators to reconsider rules governing market manipulation and trade settlement. 42. Warren Buffett's ConocoPhillips purchase in 2008 proves that even the world's greatest investor occasionally succumbs to poor timing. Buffett invested roughly $7 billion in the oil giant when crude prices were near all-time highs, exceeding $140 per barrel. Almost immediately after his purchase, energy prices collapsed amid the global financial crisis, with oil plunging below $40. In his 2008 letter to Berkshire Hathaway shareholders, Buffett candidly admitted his mistake. "I bought a large amount of ConocoPhillips stock when oil and gas prices were near their peak. I in no way anticipated the dramatic fall in energy prices that occurred in the last half of the year." Berkshire took a $4 billion write-down on the position. Though Buffett eventually recouped some losses as oil prices partially recovered, the episode illustrated his investment principle that it's better to buy great companies at fair prices than fair companies at seemingly great prices, particularly when those prices depend on commodity values. 43. Warren Buffett's energy future. Holdings debacle demonstrated that even financial geniuses can be blindsided by major market shifts. In 2007, Berkshire Hathaway purchased $2 billion in energy future holdings bonds, expecting steady returns from the Texas utility operator. What Buffett didn't anticipate was the fracking revolution that would send natural gas prices plummeting, devastating coal and nuclear power economics. By 2013, Buffett was forced to sell the bonds for just $259 million, booking an $873 million pre-tax loss. In his characteristically candid 2013 shareholder letter, Buffett took full responsibility. Most of you have never heard of Energy Future Holdings? Consider yourselves lucky. I certainly wish I hadn't. He acknowledged making the investment decision without consulting his longtime partner Charlie Munger, noting, "Next time I'll call Charlie." The case illustrated how technological disruption can invalidate even the most careful investment analysis when breakthrough innovations fundamentally alter industry economics in unforeseen ways. 44. Bono's Palm investment through his private equity firm Elevation Partners became a cautionary tale about celebrity investors entering competitive tech markets. In 2007, the U2 frontman's firm invested $460 million in Palm, the once pioneering maker of personal digital assistants. Elevation Partners acquired a 25% stake, hoping to revitalize Palm with new smartphone products to compete with Apple's iPhone. The company's Palm Pre device received positive reviews but failed to gain meaningful market share against the iPhone and emerging Android devices. When HP acquired Palm in 2010, the purchase price of $1.2 billion represented a modest profit for Elevation, but far less than hoped. The investment earned Bono the 24/7 Wall Street designation of Worst Investor in America. While Elevation Partners later redeemed its reputation with successful investments in Facebook and Yelp, the Palm episode demonstrated how difficult it is for even well-funded turnaround attempts to succeed in hyper-competitive technology markets dominated by innovative leaders. 45. Kim Basinger's 1989 purchase of Braselton, Georgia, stands as one of Hollywood's most notorious investment disasters. At the height of her fame following Batman, the Oscar-winning actress spent $20 million to acquire the 1,700-acre town located 50 miles from Atlanta. Basinger, who grew up nearby, envisioned transforming Braselton into a tourist destination with movie studios and a film festival. Her plans never materialized as financing fell through, and her career entered a temporary downturn. The financial strain from this failed investment, combined with a costly lawsuit for backing out of the film Boxing Helena, forced Basinger to file for bankruptcy in 1993. She eventually sold the town for a mere $1 million, a 95% loss. The case illustrated the dangers of celebrities making large investments in areas outside their expertise, particularly when those investments are driven more by emotional connections and grand visions than by concrete business plans with realistic revenue projections. 46. Jay-Z's J Hotels investment demonstrates how even savvy business moguls can be caught by macroeconomic shifts. In 2007, the rapper and entrepreneur invested $66 million in a partnership to develop J Hotels, an ambitious luxury hotel project in New York City's Chelsea neighborhood. As construction began, the 2008 financial crisis hit, freezing credit markets and collapsing real estate values. The project stalled, and Jay-Z became entangled in a complex $52 million lawsuit with investment partners. Though eventually settled, the failed venture represented a significant financial setback, even for someone of his wealth. The timing couldn't have been worse, investing at the absolute peak of the pre-crisis real estate bubble. Unlike his many successful business ventures, from Rossa Wear clothing to Armand de Brignac champagne, the J Hotels debacle served as a reminder that market cycles can overwhelm even the strongest business concepts and celebrity branding when the broader economic environment shifts dramatically. 47. Michael Vick's financial collapse in 2008 offers a stark lesson in trusting the wrong advisors with wealth. At his peak, the NFL quarterback signed a $130 million contract with the Atlanta Falcons, making him one of the highest-paid players in the league. Yet by 2008, Vick filed for bankruptcy, listing $16 million in debts against $16 million in assets. Beyond his legal troubles from dogfighting charges, Vick was financially decimated by a series of disastrous investments and loans to friends and family. His financial advisor, Mary Wong, later went to prison for running a Ponzi scheme that targeted professional athletes. Vick had delegated virtually all financial decisions without maintaining oversight, allowing advisors to make speculative investments in a car rental company, a wine shop, and various real estate projects that quickly failed. His case highlighted how suddenly wealth can vanish when athletes don't develop financial literacy or establish proper controls over their money managers. 48. Mark Brunell's financial fumbles saw the former NFL star quarterback lose his entire $50 million fortune despite a successful 19-year playing career. After retiring, Brunell filed for bankruptcy in 2010, listing $5.5 million in assets against $24.7 million in liabilities. His financial downfall came primarily through failed real estate investments made just before the 2008 housing crash. Brunell invested heavily in a real estate development company called Champion LLC, which collapsed during the financial crisis, costing him $11 million. He also guaranteed loans for several Whataburger restaurant franchises that failed, leaving him responsible for millions in debt. The timing couldn't have been worse, investing at the absolute peak of the market before the worst real estate crash in generations. Brunell's case became a cautionary tale taught to rookie NFL players about the dangers of concentrated investments in unfamiliar industries, particularly when those investments involve personal loan guarantees that can outlast playing careers. 49. Torrey Hunter's inflatable furniture fiasco demonstrated how easily professional athletes can be drawn into dubious investments. In the early 2000s, the MLB All-Star outfielder invested $70,000 in a company claiming to develop inflatable rafts designed to protect furniture during floods. The concept seemed innovative. Place deflated rafts under couches and chairs, and during flooding, they would automatically inflate, lifting valuable furniture above rising water. There was just one problem. The technology never worked. The company produced no viable product, and Hunter lost his entire investment. In subsequent interviews, Hunter admitted this was just one of many failed ventures he backed early in his career, including a failed clothing line and restaurant. His experience highlights the vulnerability of young athletes who suddenly acquire wealth without financial education. The analytical reflection with closing wit is clear. Sometimes investment bubbles burst literally, leaving not even inflatable furniture to sit on while contemplating your losses. 50. Towers. Financial Corporation operated one of the largest pre-Madoff Ponzi schemes in American history under Chairman Stephen Hoffenberg. Established as a debt collection agency, Towers evolved into a massive fraud operation that bilked investors out of $475 million between 1988 and 1993. Hoffenberg sold investors notes and bonds, claiming the money would purchase discounted debt that Towers would collect at a profit. In reality, he used new investor money to pay earlier investors while funding his lavish lifestyle, which included ownership of the New York Post newspaper. When the scheme collapsed in 1993, investigators discovered that virtually no legitimate business activity had occurred. Hoffenberg pleaded guilty to fraud charges in 1995 and received a 20-year prison sentence. Though overshadowed by Madoff's later $65 billion scheme, the Towers financial case was, at the time, considered the largest investment fraud in history and led to significant reforms in how regulators monitor investment companies offering high-yield, low-risk securities. 51. The Asian financial crisis of 1997-1998 began with a seemingly small event, Thailand's decision to float its currency, the baht, but quickly escalated into a regional economic collapse. For years, Asian tiger economies had maintained fixed exchange rates to the US dollar while allowing massive foreign investment inflows. This created unsustainable economic imbalances and speculative real estate bubbles. When Thailand could no longer defend its currency peg, the baht collapsed, losing over 50% of its value in months. The contagion rapidly spread to Indonesia, Malaysia, South Korea, and the Philippines as investors rushed to withdraw capital. Indonesia's rupiah lost 80% of its value within a year, while South Korea's won fell 50%. The International Monetary Fund organized bailout packages exceeding $110 billion, imposing strict austerity measures that many critics later argued worsened the suffering. The crisis revealed the dangers of fixed exchange rates, combined with unregulated capital flows, teaching a painful lesson about how quickly investor confidence can evaporate when economic fundamentals don't support market valuations. From the South Sea Company's spectacular collapse to Meta's metaverse, billions vanishing overnight, our financial history is littered with painful and expensive lessons. These cautionary tales remind us that fundamentals matter more than hype, regardless of era or technology. But I'm curious, do you see these disasters as necessary market corrections or evidence of humanity's persistent financial blind spots? Did Madoff's $65 billion Ponzi scheme or Enron's accounting fraud change how you evaluate investment opportunities? Share which investment catastrophe surprised you most in the comments, or tell us about a financial disaster we missed. The most interesting responses get pinned. If this exploration of risk management failures resonated with you, hit subscribe for our upcoming examination of history's greatest wealth preservation strategies during economic crises.